Students, I am Professor Namrata Hampiholi from Department of Commerce and Accountancy. Welcome to the today's class. So in our yesterday's class we have seen with the types of debentures, then the difference between the shares and debentures. Now in today's class we are going to see the issue of shares, that is how the shares are made available to the general public or how the general public is going to invest in the company. So here these are the ways or these are the methods through which a company can issue its shares. So here issue means they are providing the company shares. Okay, so here by providing the shares, the company provides share certificates to the public, and public in return invest or pay money for that particular certificate by the way of investment. So let us look into the issue of shares one by one. So first here is public issue through the prospectus. Yes, so we have seen in our previous videos what is prospectus. So here prospectus contains all the details of the company for the purpose of raising the funds. So here prospectus act as a what you can say, it acts as an evidence or it acts as a main role so that investor will think on investing. So this is a main basis on which the investor will think of investing in it in a company. So here the public, through offering the through providing the prospectus, it invites the public for the purchase of shares or securities of the company. So here the company issues the securities by inviting the public to by issue of prospectus, and they are asked to subscribe for the securities issued by them. So here the public, whoever is interested, have to subscribe. That is, they have to put the want or the demand in front that they want to purchase the share, that we call as subscribe. That is, they want to purchase the shares. That is, on the basis of this prospectus, they invite the public for the subscription of the shares. So here it is like a direct offer made by the company to the general public, that is, come and purchase the shares which are at the stated price, if the particular price is being stated. So these shares may be issued at par, that is at the face value, or at the discount, that is less than the face value, or at the premium, that is the more than a face value. Now the other day we have seen the how the share certificate will look. So on that they have given a face value, that was 100 rupees. So if the company is selling that particular share at 100 rupees, then it is selling at selling the share at par. If they are selling it at a 90 rupees, then it is a discount. If it is at 120, then it is a premium. So here public issue through the prospectus is the way wherein the public, where the company invites the public, or in other words, it will ask the public to come and purchase the shares of our company, by which they are going to invest the amount in the company. So this was the first, that is issue through the prospectus. Then coming to the next method here is through offer for sale. That is, here the securities are offered to the public through the intermediaries. That is, you have a middleman here to purchase a share or to sell the company's shares. So these includes the issue houses, merchant bankers, and the stockbrokers. So under this method, the shares are not directly offered to the public. As in case of the public issue through prospectus, here the shares are directly offered to the general public. But here in case of offer for sale, here those are not directly offered, but they are offered through some intermediaries. So here we have a stockbroker, merchant banker, issue houses. Okay, so there are many when we look into the examples, there are many stock brokers who deal in the shares. Like example, we have Reliance and ICICI mutual funds we have, and again there are many more like angel brokers we have, wherein these acts as a mediators, right? So we can't directly go and purchase, we have to go through these brokers. So this is where the offer for sale is done. So here they include two stages, that is, First, the issuing company will sell those securities to these issue houses, that is brokers, at a certain agreed price. That is the company, like suppose like company wants to sell its securities, first they sell them to the these intermediaries, that is these stock brokers or these merchant bankers. Then in second stage, what will happen, these stock brokers or these issue houses, those who have purchased the shares from the company at certain price, they sell them, they sell to the public at a higher price, that is they quote a higher price. So here the difference between the purchase price and the issue price is called here as a turn, TURN. So here what these intermediaries will do, they purchase the shares from the company at a certain price and then they sell it to the general public at the higher price than the price which they have purchased. So the difference what they earn is called here as a turn. So this was the second method of issuing the shares, that is offered through sales. Then coming to the next third type here is through the placement of security. So here under the placement of security, it is the sale of a stock to the pre-selected investors or the institution rather selling it in an open market. So here already there are few investors who are been already listed or pre-selected, or you can say investors or institutions, whoever want to come and invest, those are already been selected here. Okay, so for them it is been sold, or for them it is the shares of the company are made available rather than in an open market, that is it is not open for everyone, or it is not open in a available in an open market. So here in this method, the broker buy the securities with the intention of placing them to their clients, that is already pre-recorded pre-selected clients will be there, or the investor will be there. So here what in brokers will do here, or the issue house, what they will do here, they purchase and they will sell to the selected investors or the institutions. So here it is like somewhat the relationship between the wholesaler and retailer. It is like here the stock brokers act as a wholesalers and they sell it to the public as in a retail price. Here again the same, they earn here a profit between these two prices by reselling it to the public. So here the brokers will maintain their own list of the client whom they are going to sell again and again. So here such a placement, it means a private placement. So here the difference, again the difference of the price is called here as a turn. So in the private placement, again there is an agent who is going to sell but to the selected investors or the institutions. Then next, coming to the initial public offerings, that is called as an IPO. So usually here initial public offerings is done by the public company, but in case of the private company, if it wants to go for like if you want to go for public IPO, that's initial public offering, first it has to convert into the public company. So when does it convert, when does a private company convert to the public company? That is if they find that there are like enough investors. See anyway the private company have to collect or raise the funds from the friends, relatives or the family members. But if the business is expanding, okay, so then when they feel that they can go for the public, then when they go for the public enterprises after following the certain procedures, then they can go for the initial public offerings. So here the issuing company issues the shares here to the client of the broker to the stock exchange here again. So under this system here the brokers will place orders on behalf of the client through the computer trading, right? So as the like now after digitalization, whenever we want to purchase, it is to the online basis. So here what will happen in IPO, that is initial public offering, the broker will place a number of shares on behalf of the clients. Like if you all want to purchase certain shares from the certain company, then what you have to do is you have to place an order that with the brokers, then on your behalf they place it to the company. Then after the finalization of the allocation, then the brokers are advised their clients to submit the application and deposit that amount through the broker's account, so that they pay to the broker, then the broker will pay to the company, then the certificate of the share will be issued to the clients. So this is how the initial public offering will takes place. So wherein the public company or the private company can trade it in a secondary market. So primary market, the market is divided into two parts here, that is primary and secondary. So a primary market is a market for the first or the fresh issue of the shares, wherein usually the initial public offering goes, and here secondary market is for the shares which are already been traded in the primary market. I hope you are clear with this IPO. Then next comes here is rights of bonus, rights of bonus shares. So here the bonus shares, as a name itself we can make out that the bonus extra it is. So here in this bonus shares, what will happen here is the company, whenever it earns the profit, or whenever it has a good accumulated profits and reserve, that is the profit which has kept aside, how we do in our daily or regular basis savings, if the company has such accumulated profits and reserves, so what they will do is they convert them into the shares and then they sell it to the general public, or they make available it to the investors. So this will so because of this, what will happen here, the number of shareholders will increase, and in reality it is only the book entry in which the reserves are reduced and the share capital are increased. No doubt the accumulated whatever the profits and reserves are there, those instead of showing them in the reserves and that is reserves and surplus, those amount are converted into the shares and that are made available to the investors. So there is only the change in the book entry here. So this is what we call here as a issue of bonus shares. Usually this issue of bonus share is not a issue of, or it is not a capital which is freshly raised, or it is not a method wherein a fresh capital is raised. It is out of the accumulated profit or the reserves. Then next coming to here is stock option. So here the stock option is also called as employee stock option, or it is also called here as a sweat equity. So this is a method of offering the shares or giving the share to the employee of that particular company. It is an incentive which is given to the employees to motivate them and to motivate them to stay in the company and participate in the profitability and the prosperity of the company. So here to motivate the employees, and if there are really very good employees and because of them a company is making a very good profit and it has a market and its market position is very good, so to retain such type of the employees, what the company does here is they issue them shares. So that is called here also called as a sweat equity, that is like it is a result of their hard work, it is a result of the hard work of the employees. So this is also called as ESOP, wherein employee stock exchange. So it is from the July 2004, this stock option offered to the employee must be implemented through the merchant bankers, that is they have to issue them through the merchant banker, that the company whoever is issuing has to go through the merchant banker. Then this book building we will be studying in the later part, because it has a separate explanation for explanation, and there are little calculations which are involved in the book building. So before we end with this type, there is one more, that is right issues. So here right issues means there is one more type which is called here as a right issues. So here the right issues means a fresh issue of a share by an existing company to the existing shareholders in the portion of the number of shares already held by them is right issues. That is, it is again the fresh issue to the existing shareholders, that is shareholders are already holding some of the shares in the company, for them again the shares are being issued the same shares which are already held by them. This is called as a right issue. So here there is a circular to the existing shareholders. The additional shares are being offered to them, and a statement in lieu of prospectus is submitted to the registrar of the company. So here what happens here is, already existing shareholder, that is already the sum of the shareholders are holding the shares of the company, to them the shares are being again issued to for the raising of the capital here. So here there is a rotation of the shares, we can say. So for them they issue the statement in lieu of the prospectus instead of issuing the prospectus. So here the right means here an option to buy a certain securities at the certain price with a specified time period. So here the shares offered to the existing shareholders is called here as a rights shares. Okay, so like how many shares are issued here? Already how many shares they are holding, that is existing shareholders, before how many shares they are holding, the same shares are being issued to the shareholders. So I hope you are all clear with the issue of shares. So in the next class we will be dealing with the book building, which is a different concept here, which involves certain calculations.